everybody. Lindsay Davis here with Spartan Invest, and I am so excited to welcome back Aaron Chapman with Security National. So Aaron and Maureen McCann, also with Spartan, got together right after everything really just shut down. It was about, what was it, Aaron, about mid-March? And so this, and really talked about kind of what we're seeing right now in regards to real estate, lending, just kind of what was going on, what were the speculations. And so he's joined us back to kind of give us an update. We're here at the end of April. We see some things possibly opening back up, but other things spike. And it's been a lot of ups and downs. So thank you so much, Aaron, for joining us back. I appreciate it.
Well, I always appreciate the opportunity you guys allow me to have to communicate to your database, to your investors, help quell a lot of some of the fears that are out there, because and even the amount of research I'm able to do and the stuff I'm able to gather, I'm only getting a small snippet of what's really out there. But at the same time, everything that I'm searching for has to do with those who we serve, right? Those people who you are taking care of, being the boots on the ground for their business, and the people I'm trying to help give good thought process to consider as they're making decisions with their business. So thank you.
Yes, and so I wanted to kind of circle back with where you left off with the last one. And if you're interested in kind of going back and watching that video, it is available on our website at spartaninvest.com. You can catch it there or on our YouTube channel. But so where you guys left off and kind of the uncertainty and hey, now's the time, the differences in interest rates, et cetera, et cetera. So in the lending world, what's changed since then?
So at that time, we were trying to help people get comfortable with the fact the rates were all over the place and understand that because they started shopping like mad. It's like, well, if you're hitting me with this hard rate, I'm going to look around. Well, they started to find that every lender out there was facing the same problem. The problem was, the mortgage-backed securities lost a lot of ground. So we needed to explain where interest rates came from. People need to understand that it wasn't the Fed lowering the rate down to zero. It wasn't watching the 10-year. The 10-year treasury has to do with people giving money to, well, basically investing money into a bond where the federal government can use that capital and then pay them back a return for 10 years. It's a bond, a lot like kind of a CD, right? That had a set time frame. Well, the mortgage-backed securities were created back in the early 1970s by Lou Ranieri with Solomon Brothers. I told everybody to go watch The Big Short, keep the kids out of the room so they could see how it started. And then as investors put their money in these pools, they would lend it out. And then that, as the supply grows, the cost goes down, rate goes down, right? As the supply decreases, the rate goes up. That's what happened on, I don't remember the exact date that it all happened. It was right around March 6th or 9th, something like that, that the market just freaked out. A lot of margin calls, a lot of banks had to sell off those securities, and interest rates went overnight, went as high as 5 3/4, charging 2 points for a single family 20% down investment, literally overnight. So I had to calm people down and let them know this is why. So I directed everyone, I think we talked about that on the conversation with Maureen, to mortgagenewsdaily.com and go to their MBS website. So it'd be mortgagenewsdaily.com/MBS, as in mortgage-backed security. And then you can watch the charts. And if you clicked on the 4.0 chart, you'll see down there where it references the coupon. It's like the UMBS, Universal Mortgage-Backed Security 3.5 coupon is what will pop up. You'll click on the little link there that says change coupon. Go to the 4.0. That's the closest one to watch for investors. And I could show them how the market was losing ground every day. And then it started to rebound, and we thought, cool, our rate's going to get better. But what happened then was that rebound was because the Fed was dumping tons of money in, tons of it. And because of all that money, what's happening is dropping the rates really quick. And dropping those rates real quick, they were getting a lot of people to try and refinance. And it's been happening in a rapid way. Those massive refinance demands actually caused an unintended consequence. So when it comes to mortgage services, I don't know if you're familiar with we've done a loan for you personally, and you probably had the loan. I'm guessing you got a letter within about a month saying now you get to make your payment over here, right?
Right.
Everybody gets that. They all ask me, do you sell your loans? Well, no, we have a different servicer take control because they're equipped. They're a big organization that has the capability to collect payments, sort through it, pay your taxes, pay your insurance, or at least save that up for you and pay it when it's due. Well, Security National is only so big, right? We can only handle so much of it, but we write billions of dollars in loans every year. We don't have billions of dollars to put that out. So we get the money from the pools and then we sell the servicing. Well, the servicer will pay the right to have that. They'll basically pay 1% to have that right to take that. So on a $100,000 loan, they pay $1,000 to get the ability to collect those payments. Kind of like a superintendent or a property manager at an apartment building, right? So they go around and collect the payments. But the difference is, that let's just say that the property manager, let's say Spartan, you guys guaranteed the rents to everybody for the entire time. They said, hey, we're going to collect your rents for you. We're going to guarantee that. But as we collect the rents, we're going to take a significant portion of it, right? Well, if something happens that people stop making their payments or they moved out really quickly, but you continue to guarantee it, it would cause you a lot of grief, right? Well, that's what happened. These guys bought those loans, guaranteed the payments to the pools, the mortgage-backed securities pools, and then people were refinancing. Well, if they paid $1,000 to buy that loan and they got to only collect about $300 a year in actual revenue for themselves, it'll take them about 4 years to break even between what they paid, what their overhead is to maintain it. Well, if they had people refinance the first year of that loan, do you think that they made any money? They went in the hole huge. As a result of that, the entire back end of the mortgage industry, the servicing industry, said, we don't want to buy your loans anymore. And not only we're not going to buy them, we're going to demand that you pay us. So instead of paying $1,000 for that loan, they're now saying, give us $500. It may not be 500, maybe 350, maybe something like that. But they're saying, now you're going to pay us to take it. And that way they're already in the black when they take that. And anything they collect and they get their little piece of, they continue to make money on. But they're also having to make up for billions of dollars in loss in these last few months. So now interest rates have been affected as a result. We're seeing points being charged for your 20% down deals across the board because no longer is that $1,000 initial injection of capital coming in. There's actually about an approximate $300 to $500 exit of capital immediately. So they have to charge something up front, so that because that $1,500 swing, if you will, is happening around the front end. So you're going to see a little bit of a change in points. That's just on the 20% down stuff. And I'm seeing a point being charged right now for low fours. It's still remarkable. So we have stability in the market since that conversation with Maureen. It's gotten very stable. It used to be in the last 45 days, I would just incessantly check the rates. And I'd find that I could get things priced well. And I'd lock myself in a room and just lock like 50 loans until the pricing changed again, because it was changing minute by minute. I did that 3 times during that window, and now it's pretty consistent ever since. So that being said, my situation now is I've got what I'm seeing mostly happening within the market today is a lot of people getting really fearful about the forbearance situation. And that we could be in a scenario here with forbearance being a reality that people are trying to use for their way of creating, how are you gonna put it, reserves, if you will. So they're saying, hey, if I've got somebody potentially not paying rent, I need to be prepared for this forbearance in case they don't pay rent. The other thing that I'm seeing is they're also thinking, well, maybe even if they are paying rent, I'll just go into forbearance and then I will get more reserves in place. That's a huge risk, a massive risk.
Yeah, and it's a huge point, especially for investors, because there's a lot of consequences to taking advantage of the forbearance. Now, obviously, if you need it, take it, please, but only if you need it. So really go into what the different options are, because it also depends on your lender, on the options that they're giving you. There's several different ones, but go into what that might look like in the future and when to use it. Obviously as a last resort, but.
So the forbearance situation that we're seeing, one, it's definitely not a wise thing for a person to start looking at doing, because ultimately what you're going to see there with the temptation to start trying to build up additional reserves by saying, hey, I'll just go ahead and put this off because my bank reached out to me, or my bank's reaching out to me. All of them are saying, hey, you have the ability to not pay your payment. Well, the payment's going to come due sometime. Many people are of the belief, because of the misinformation that's out there, that they can put it on the back end of the deal. Or so that means just don't make payment for 4 months, just add it to the loan balance and they'll pay it off later. Seems like a sound way of going about it. And then I've also had some people think that, well, I'm in a position now that, man, my tenants may not pay rent, so I'm going to go ahead and just get ready to deal with that and have the money set aside. How many have you seen that are not paying rent, Lindsay?
Right now, I've got to brag pretty bad, pretty hardcore, because, last time you guys spoke with, or you and Maureen spoke, it was still March. And so we were really unsure of what the rent collection actually was going to be. As of right now, we've collected 85% of April's rent. So, that's a little bit better than what we typically do, and
Really?
what we found is that the tenants that are diligent about paying their rent and always pay their rent, they were paying their rent, and the ones that were typically late were late, and then the ones that are in need, we've set up on rent relief programs that we're executing internally. But yeah, at 85%, so 15% are still unpaid, and we're not at the end of the month yet.
So, and when you think about that, everybody I talked to said that they were as good or better than they had been. So that's why I'd ask them, why would you even consider forbearance? So the thing that they said, well, because of the ability to put it on the back end. Well, come to find out, that's not going to go on the back end. If you, let's just say my banks that have reached out to me saying, hey, you can go 4 months without making a payment. Well, if I went 4 months without making a payment, come month 5, let's say it was $1,000 a month. I go month 1, no payment, month 2, month 3, month 4, that's $4,000. Come month 5, I got to pay $5,000 right then. Is it easier for me to pay $1,000 a month right now, or $5,000 a month down, $5,000 in one chunk later? It's going to be a lot easier to pay the $1,000 a month. That $5,000 is going to hurt. So then they say, well, but they said they could put it on the tail end. I was like, no, it's called a modification. When you're talking about loan modifications, we went through that process in the past. I can only go off experience. I don't know what's going to happen, what they're going to do to the mortgage industry and how they're going to look at these things like underwriting guidelines going forward. But if you look backwards to the times of 2008, 9, 10, 11, and 12, I personally went through a modification, several modifications. I actually had I don't think I had any foreclosures, but I had short sales. I was in a motorcycle accident in 2008. I had to wheel into the title companies in a wheelchair and sign away these properties that were just getting obliterated out from underneath me. And it took me up until 2000, I think it was 2015, before I was able to buy again as a result of that. All the stuff that had happened there. And so then I started building my portfolio back up. But when looking at the modifications, they saw those modifications on my credit, and I had to wait, I believe it was at least 2 years from the modification before I was able to get the loan. Now, going forward, I don't know how they're going to speak to that. All I can do is look backwards. Backwards said it's going to affect your ability to purchase. Now, many times I've had people call me up and kind of rattle my cage. Well, don't you think since the government's mandated this, that the lender should just, overlook all of it? Like, well, let's consider what we're talking about here. We're talking about you coming forward and saying, I have a financial issue. I am in a financial situation that I cannot make my payments. You're declaring that openly. Now, initially, you can just say it and they're going to believe you, they're going to roll with it. But if you need to have that money moved to the back end because you stockpiled those reserves, let's just say you went the 4 months on multiple properties and hoped it would go on the back end, well, then you didn't have the capability to make that payment when they came to you and said, hey, okay, it's month 5, now you got to pay it all. Now you got to go through the modification process. Now you absolutely have to prove you have financial difficulty. Let's say you're successful in proving that. Why would any banking entity that is charged with ensuring that they're not putting you in a negative position financially by lending you hundreds of thousands of dollars, then just take a scenario where you prove to them you had a financial deficiency and say, oh yeah, you're right, let's go ahead and just keep lending to you? No, they have to honor what you proved to them. You proved to them you had a difficulty. They're not going to put you in a position of continued difficulty. They're going to let you get past all of that. Then you have to prove you're past it. So all you're doing is increasing your difficulty in getting financing down the road. You're saying that you are financially, I wouldn't say insolvent, but you ran into the financial trouble, so you couldn't make your payments. Now you're coming back immediately after it's all said and done. It's like, oh no, I'm good. No, they're going to have you wait. They're going to let you get your I'm just going to be strong to let you get your shit straight financially. And then from that point, they can help. You can show a case for a reason why you should be able to get financing going forward, because now you've proven you're in good shape. But there's got to be a waiting period. And one of the things that we had put out this last week, on last Thursday, I was with Barry Habib is his name. He was on a call with me just like this, sharing screens. We talked about the risks of forbearance. And when the Fed started dumping all that money in, and the risk of dropping the rates lower and really hurting the servicing department, he wrote a letter and contacted directly to the Fed about that risk, and they tapered back and evened out what they were putting into mortgage-backed securities to get us a more even interest rate and a more even market. And he was willing to come on to this particular conversation with me about this, and he pointed some really good things out about it. And he's of the belief that we're going to see some hits in the real estate market. We're going to see the market decline in some respect. Now, I have to qualify that, because some people are going to be on this call saying, "Whoa, do I not go into contract with more investment properties?" That's not. I don't believe what he was saying, because when you know Barry Habib as well as I have, because I've been listening to what he's been saying, and I've been tracking his information that he puts out every day since 2003. And the majority of the people he communicates with are loan originators doing loans for people buying houses. I'm one of like 5 people in the United States that specialize in real estate investment. There's hardly anybody that specializes here, because it's very, very hard. Nobody likes to do what's hard. They like the first-time home buyers and all that stuff. But when you look at those markets, first-time home buyer loans I wouldn't say they're obliterated, but they're harder to find. They're not giving all these grant programs and free money like they were. Jumbo loans, people buying houses that are $1 million houses, that money's gone. It's hard to get your hands on, if at all. The non-QM, they call it, like there's like your non-owner-occupied deals that's not looking at income, those are gone. They're obliterated. Your blanket loans obliterated. The low down payment, Fannie Mae, not Fannie Mae, but your FHA, your VA, and your USDA, those things have been hit pretty hard. So what's going to happen as a result of that, the market when it comes to owner-occupied housing is going to be affected significantly. Not as many people will qualify for loans. Because of that, there's not as many people are going to be bidding on these houses, not driving the price up. It may actually recede some of these prices. We've got a low supply, huge demand. The demand is going to shrink because fewer people can get loans. That's what's going to happen. So he's of the mindset that if you decide to mess with your credit when you really don't need to, forbearance is there for a reason. If you're really financially hurt, but if you do it just because you think you're going to benefit somehow, you're not going to benefit. In fact, you're going to be stuck sitting on the sidelines while the rest of the world that stayed and kept their stuff clean is going to jump into some of these deals that may exist in their neighborhood that they might be able to flip later. Who knows? But that was his mindset behind the market being hit as far as real estate is concerned. Now, for the turnkey investor, I'm not seeing anybody backing down on that. When it comes to the acquisition of turnkeys, the rehab, the sales of turnkeys, and the rents, I'm seeing full steam ahead in every market I'm in. I'm licensed in 23 states.
That's one thing that we've also seen as well in Alabama is the purchase or acquisitions, the renting of the property or security deposit influx. It's all been very stable, if not elevated, over the last few weeks. I am concerned. So the owner occupant piece, obviously doesn't affect you and I as much, but the overall market conditions, what do you think that might have, aside from driving the price down on the investment side or on the acquisition side?
So the overall market, well, one, from the mortgage perspective, we're going to see a tightening. There's no two ways about it. The ability to get money to invest in this is going to, from the mortgage-backed securities pools, is going to be affected. So I think that eventually we're going to see some rates go up. We're going to see interest rates adjust at some point. And what I keep telling everybody is, take advantage of it now. But in reality, interest rate going at today's rates, they're all good. They're all awesome. But in reality, it really doesn't matter that much. Interest rates don't drive the market the way that, or at least drive a person's business the way they feel that it should. Because what I found is that when I do the numbers on it, no matter what your rate is, because we live in an environment with, that's an inflationary environment, because of the tax deductibility of things, and a real estate investor makes out like a bandit on it, regardless of what the rate is. So I want people to get their mind wrapped around that first. That's going to change. The lending guidelines are going to change. They're going to get a little bit tighter. We may not have the ability to use rents to qualify a person that doesn't have a history of owning rental properties. That could happen here. Because what we're at risk of is any real estate investors that are making claims about their finances or saying, "Oh, I'm having a hard time making the payments because I really need the rents to even qualify." That could come back and bite us all in the ass. So just know that could happen. That could shrink the portfolio of people able to buy real estate investment properties for the first time. They may have to qualify with those payments. So that could happen. The other thing that definitely will happen eventually, like I just said, the interest rates going up. And I did share on, when conversing with Maureen, I think people need to hear it over and over and over again about how the taxes affect the interest rate or smooth it out. So I had a client in 2017 purchasing 2 properties, same price, same floor plan, same street, same potential rents, new builds. And they were and one was, the only difference was one was just about done being built. The other one was still a bare lot. They had yet to break ground. Closed on the first one, December of 2017 at 4.75% rate. Not far off where we are today. In fact, today we're a little bit better than that. He was very happy with the rate, very happy with the outcome, closed. Then we got quantitative tightening through the Fed, with the new Fed chairman, Jerome Powell. Now, are you familiar with the term quantitative tightening? Completely opposite of quantitative easing, right? So easing was them dumping money into the mortgage-backed securities, bringing the rates down. Tightening is like, we're going to taper back. You look at the history of them dropping money into the mortgage-backed securities, you could see almost an average of like $20 billion a month. They backed it down after the first part of 2018 to about $100 million a month. That gap is massive. 100 million to 20 billion, that's a big gap. So, of course, the supply shrunk, right? And as we discussed earlier, when the supply goes down, the cost goes up. So with the shrinking of that supply, the interest rate when they were done building property number 2 went to 5.75%. So 1 full percentage point jump. So because of that, the guy freaked out. He's like, "I think I'm going to cancel deal number 2. I'm like, "Why are you canceling?" He goes, "I'm losing $600 a year." I'm like, "How are you losing $600 a year?" He goes, "Well, it's the same price, same amount of money out of my pocket, but the interest rate's a point higher, so that's there's a $49.97 difference per month. When you round up, it's $600 a year." I'm like, "Okay, I get where you're coming from." He goes, "But in our initial conversation, you agreed to let me be the trusted advisor at your board table, gives you things to think about before you make a decision." He goes, "Sure." I said, "Do one thing for me." He goes, "What's that?" I said, "It is May right now, so you got your taxes done last month. Call your CPA. Ask him what's the difference in what you'll pay in increased income versus property number 1 with the higher cash flow versus property 2 with the lower cash flow. Then ask him what's the difference in the tax deduction you will get on property 2 with the higher interest rate versus property 1, then call me back." 3 days later, he calls back and says, "Okay, let's close on property 2. I'm like, "Why are we doing it?" Because it's no longer $49.97 97 cents per month difference in payment. I'm like, "Well, what is it?" He goes, "It's down to $3.55 after I file my taxes." I'm like, there you go. So my main reason for sharing that a lot over and over and over again with people is so that they get that interest rates don't matter. You have a business. When it comes to this, the real estate you purchase is going to create revenue in many different ways. It's not just a cash on cash return. That is the simplest and easiest metric to gauge one house to another. But if you try and live by cash on cash return as your greatest return, you need to take that paper, wrap it up, throw it away, because it doesn't matter anymore. It has no value to you at that point. That was the deciding process between all the different properties offered by Spartan. That's what you're looking for, is which one do I want? Once that's done, it's trash. Because now where your real value comes is one in the amortization of the loan. Amortization of that loan. You buy a $100,000 property, put 20% down, and you divide that $80,000 loan over the 30 years. That means your tenant is paying off $2,666.66 per month, averaged over 30 years. That's increasing your initial deposit, that $20,000, by 13.33% of the original $20,000 every single year. So a person needs to wrap their head around that. And once they wrap their head around that and understand that they're growing it just by amortization of the loan before cash flow, then you factor in the tax benefits, you factor in the cash flow, and I haven't gotten into inflation. That's something you got to go back and watch the thing with Maureen. The inflation piece is the greatest creator of wealth for anybody in real estate. So the interest rates, just to wrap this all back around to what I'm going to see in the market, we're going to see them go up. But you got to get your head wrapped around the fact that you are the CEO of your real estate investment business. You got Spartan running it for you, boots on the ground. Don't worry about what the rates are going to do. Don't worry about the market. Move forward with the same principles you started with. Your tactics and strategies will change, but your principles need to endure. If you don't have the right principles for your business, you shouldn't be doing it.
Man, if I could just get all of that on a little snippet and just send it out repeatedly over and over and over again, you're 100% correct in that there are so many other avenues to build wealth through real estate that your cash flow or cash on cash, it's one of them, yes, and it's a very important one, but man, it doesn't even come close to encompassing all of the ways in which you can do that. So I just love that. That was beautiful. It was absolutely beautiful. Thank you.
Well, I'll be there in October when we're doing you guys' Spartan Summit, and I'm going to hit on all that with real numbers in front of the whole audience, so they can see actual numbers and where I'm coming up with all the math, and let them do the math in front of us. Everybody's going to have to get their pad and paper out, and they're going to have to do the math as I'm popping up on the screen, so they get their mind calibrated properly to see how this works. And then the only thing they have to decide at that point is who do they want on their property management side, who they want ferreting out their real estate for them, who they want on the financial side. Once you get the right team, that's all that matters. If you have a shit team, I don't care what house you purchase. I don't care if it's on the hill overlooking the bay, built out of solid gold brick. Your team can screw up your rental capability. You can have this little hut in the middle of a jungle that nobody can get to. If you got a great team, that thing will stay rented and cash flowing.
Couldn't agree more. I mean, we are renting in some very, very rural areas in Alabama and consistently produce really high rates of return for our investors. So thank you for that. I appreciate that. And I cannot wait until October, man. I hope we are free and clear of all of this, because we are so excited about the summit and having you come and share more information on that. So kind of to circle back, we talked about the interest rates and their importance, but overall with the closures, local economies, the jobless claims that we were talking about beforehand, how are you seeing that affect your incoming applications? I know we got a ton, or you guys got a ton of refi apps a month ago. Has that died down? Talk a little bit about that.
Refi apps has started to die down. Now, I've been trying to quell refi apps forever, when it comes to just rate and term. Refinancing just for rate is never a wise idea. And the way that I back that up is I have, all the properties I don't have anything under 5.25%. I just don't. In fact, my highest rate is 6. My background right here is my property in Missouri. I know it's a green screen, but I'm trying to break up what people have to see. And so that's my place where I go and I stay in Missouri. Right outside that wall behind the window right there is, if you look on my website, that's my office. My website is a redneck sitting on a porch. That's me sitting on this porch, and you've got my office right there, which is also a cabin built in the 1800s. That place is 6.99%. I don't care to refinance it because it's still cash flowing the way I need it to be, right? The refinance is just wasting money because we just proved that the interest rates matter nothing. So when it comes to what's going on in the market as far as refis, I've always tried to quell those because it's not wise for the investor. It'd be great business for me, but I'm not there to steal from people. I want them to, if they're going to refinance, to pull cash out to expand their investments. Now, we have seen as a industry, refinance applications spiked, but purchase applications have dropped over 30% year over year. My purchase applications have gone through the roof. So when you compare the industry as a whole, they've dropped a lot, but for real estate investors, they've gone up. So I don't deal with a lot of home buyers. I don't deal with realtors. I don't deal with, in fact, I live in Arizona. I did 723 transactions last year. I did, I think, 5 in Arizona. I don't chase home buyer stuff. I'll still do them for my investors. I'll do their primary residence refis, their purchases, their families loans. I don't market for that business with people I don't know, period. So because of that, and I target myself in the real estate investment world, ours has actually increased significantly. We're now carrying the largest pipeline I've ever had in my career. We're over 350 loans in process right now for houses with contracts or cash out refinances in process right now. So for the real estate investment world, it's going up, at least from my perspective. I can't speak to everybody who's in my space, but we're seeing a lot of increase in the market because people see the opportunity. It's kind of like what Warren Buffett said. When there's blood in the street, he gets greedy. Well, I'm saying I changed it a little bit. When there's blood in the street, you get naked and go swimming. And that's what I'm seeing people doing right now, is they're jumping in there saying, this is my opportunity, because you don't want to miss out on this phenomenal opportunity because you were timid. And I'm seeing a lot of people jumping in. I've seen a few people pull out. I'm like, dude, you don't want to do that. I've got you locked at a rate that's amazing. This is when rates spiked over 5%. I had some people locked in the low fours and like, I don't know. And they backed out. I'm like, dude, you're nuts. And I still think that way, but hopefully they're going to come back around and figure it out. But we're seeing that jobless claims are through the roof. Absolutely insane. In fact, I was showing you a chart earlier, and I'll just pull it all up here. I think people need to see this chart. That back in 2009, we had can you see the chart, Lindsay?
Yeah, I can see it.
Okay, so this was February 26, 2009, back when it was at its peak, in as far as our economic history is concerned. This is right now. This is where we're at. This actually today, it's come down a little bit from where it was. This is April 16th. I can't get it to jump on to today itself, but this is just a few days ago, April 16th. This is how much our claims have just spiked. If you go into the continuous jobless claims here, and you start looking at those, you start seeing that there's a continuous claim. So this was the continuous claims that endured. So the first one is initial claims. It's just people just filing for unemployment. This is the continued unemployment claim. And so you can see there's a higher spike back in 2009 in July, because it continued from February to July. But look at where we're right now. We're off the chart. So that is definitely a concern, that there's a lot of people that are, their jobs are dissipating. I'm going to say they're dissipating. They're kind of on hold. And where is this all coming from? It's going to be your service industries, the restaurants. It's going to be hospitality. It's going to be things like that. I can speak for the medical industry, man. Those guys are not, they are not without job right now. My wife is a nurse. She works in an ER. She's a charge nurse, and she's a trauma nurse, and she's putting more hours, more time in. They've actually canceled vacations for people, saying you're here, because they've got an extreme amount of coronavirus in their hospital. It's pretty crazy. So we're exposed, and we're seeing it happen right here in our own neighborhood. And I've had a lot of people, a lot of fear that's coming to me. If people talk about, and actually there's some interesting conversations I've had where they bring up, like, well, you really don't believe it's a virus, do you? This is a coup, or this is a lie from the Fed, or this is actually the 5G network. I've heard all these different theories. Bottom line, guys, it doesn't matter what it is. This is people freaking out about something they have no control over. Control yourself. What do you have available to you today? You have to be able to get your mind right, get your focus right, and start your day differently. If there's anything I can offer to anyone who's listening, is that you need to, if you don't have a commute anymore, take the exact same amount of time you'd have taken for that commute, especially Californians, that 30 minutes to go 2 miles that you don't have to do anymore. Take that 30 minutes to start your day right. Figure out a routine, get a morning routine down, get your mind in the right frame to get started for that day and be productive. Because there's a lot of us still have jobs working at home, but we've wasted a lot of the time given to us. And it's pretty insane to see what's going on out there. One of the other things we're seeing in the market, Forbes had an article that went out this last, probably about 2 weeks ago. People are consuming more really crappy foods, more alcohol, more weed, more streaming, more Netflix and Amazon Prime and all that stuff than ever before, and they're consuming more porn than ever before. And I don't know if you've seen my books, Lindsay, the book number 3, Quit Jerking Off, it talks about the statistics on porn. I know that probably not what we're heading right now with this conversation, but if you look into the statistics show in 2018, one website alone logged over 6 billion hours of time on that. One website. So people are wasting that kind of time. That's 5,000 centuries of time lost in the productivity of man in 1 year. And that's the information on Forbes says that it's spiked by 11.5%. What are people doing with their time? Why are you wasting it there? There's so much opportunity out there, especially for our real estate investors. Don't add to that statistic. Spend the time working on your business. Take that extra time to really focus on where do you want to be after this is done. If your business is not kicking ass right now, is it because you failed to set aside the right assets, or at least not so much the assets, but the reserves from your cash flows that you had coming up to this? Are you worried about your reserves because of that? Did you buy your company Tesla because you're now super investor now, and you took from your cash flows to do something like that? It's called embezzlement in the corporate world. Think about how you're running your business. Re-engineer your business today to be able to make it through something worse than this. This is a great trial run for something else possibly. We don't know. I'm not a prophet or a predictor of things, but take from this what it's giving you, an opportunity to see what it's like to either be forced retired, right? Or to have your complete job wiped out and you have your real estate to lean on, or the ability to grow your real estate investment business smartly. This is a great opportunity for you. If you're wasting that time on Pornhub, you need to be questioning what you're doing.
This is all true as well. So
it's market statistics. You asked about the market.
That's true. This is very accurate. Really walked into that one. So I completely agree, though, as far as taking the opportunity to work on the business instead of in the business, because if we're, all of our employees are working remotely, and I no longer have a commute right now as well. So trying to get to the little processes and things that you just typically don't have time for in the day-to-day. It's a really great piece of advice. But when all of the investors are communicating with us right now in our sales team, Maureen and Danny, the biggest questions now that we finally have kind of the April rent collection statistics, because that's the big question mark of, is the tenant base going to be subject to unemployment or a loss of job, et cetera? What does that look like? So now that we've been able to kind of answer that question at the end of April, we're just flooded with a lot of questions as far as what the future looks like. And, we can't predict that either, but I'm curious as to your feel, because there's a lot of opinion out there that, hey, we'll be able to snap right back. I completely disagree. I think that this is going to have a dramatic effect on the commercial real estate arena or whatever. And so I'm just curious what your thoughts are kind of once we start to open the shelter orders, start being able to send people back to work and in, a safe way, in the specific phases. I'm just curious what your thoughts are on what that might look like for the future. And by the way, thank you so much to your wife, who's a nurse, who's going in day in and day out and taking care of those that are sick and that are truly affected by this. That's awesome. So thank you.
Well, thank you. And yeah, she and my daughter work together on there, and they get a lot of that gratitude from people. And they also get, man, it's amazing how many health workers are getting stuff thrown at them for, hey, why are you out here? And why are you walking around? Like, they got to get to work somehow, right? So it's a really interesting dynamic what's going on with people. But that what really is the main answer to your question is, what do you think people are going to do? I definitely see a difficulty in the commercial real estate world because they've gotten used to being at home. People are creatures of habit. You get them into a forced habit for a certain length of time, they change. Every single guru in the world says, do something for 30 days and you've now created a new habit. We're going to hit that 30-day market. I think we're probably getting close to it. What's going to happen there? What's going to happen with humans? How are humans going to react to now you're free to go out? I mean, I'm not a conspiracy theorist at all. This is not some crazy, whatever, but look at what we've created here in a short window of time. We've created there's people aren't assembling. They're not getting together, right? They're actually, they're staying in one spot. They're consuming a lot of just nothingness, and we're becoming a cashless society almost overnight. There's few people are accepting cash because they don't want the germs that's on it. Well, there's been germs on freaking money forever, which is really amazing to me. And we're now thinking about this. So when you consider some of the places that cash ends up, why would you all of a sudden be freaking out about it, right? But this is the world we're living in, and because we're creating these habits, it's going to change the dynamics of it as a whole. So we as entrepreneurs need to figure out how are we going to react to humans, right? One thing that's going to be huge, I think, is for the single family residence investor is going to make out very well as far as I'm concerned. Because right now, when we think about the people that are under those stay-at-home orders, that have their children home from school, they're trying to work from home. As we're starting up this conversation, you were subject to that whole situation, right? You had, children doing work in the other rooms, your husband's walking through on a business call. Can you imagine that in a 600 square foot apartment, Lindsay?
That'd be rough. That would be horrible.
Exactly. What would it be like? You can't send your kids out to the common areas. They can't go outside. They can't get on the playground equipment out there because, God forbid, some other kid was sneezing on it, right? So now what do we got? In the state of Arizona, it burns everything so fast it doesn't matter. So we probably have a little bit of a different world here. But think about that. Stuck in a 600, 700 square foot apartment. You've got your kids all over the place. God love them, but man, they're going to drive you crazy when you got to be on that phone call, that important call to build your business. But we're also seeing people becoming more tolerant with their kids because they realize there's nothing more they can do about it. It is what it is. The people on the other side of the line is like, oh, cool, you got your kids. Tell me about how you're doing stuff. It's opening up conversation. It's going to change the relationships and the communication between people, I think, for the good. But it's also going to take those individuals who are sitting in those apartments saying, damn it, I can't wait to rent a house. They can't wait to have a yard. They can't wait to be away from that. So they are going to, on the very first opportunity they have, to go find a house that fits their family quickly. So those who have investment real estate in the single family world is going to do awesome. Those that have duplexes, fourplexes that have yards around them, they're going to be awesome. People that have these massive apartment complexes, I'm involved in some syndications. I think that those who are doing those, they may see a hit there. I don't know. I can't speak to it. We also have a shortage of housing. So they may still be just fine, but I don't know that they're going to see the family concentration that they had before. That may be different. So that's my thought.
Oh, sorry. That's a really good point too. I just want to touch base on that too, because if you're looking at moving from the apartment to the single family home, in addition to harder access to funds on the purchasing side, so that same potential resident that's living in an apartment may not be able to now do an owner occupant loan, or as easily may not qualify if the restrictions get tougher. So again, like you said, the single family home rental, that's a positive for that one.
Oh, and I think that that's where you're definitely going to see a lot more families going that have been in apartments in the past, and you're going to see those, the smaller, whether it be a couple or a single individual living in the apartment. So I don't think that the apartments or your duplexes, triplexes, fourplexes will suffer much. You're just not going to have as many kids running around them. So it's going to change that dynamic, I believe. And then, of course, we're going to increase our pool of renters because of the fact that fewer people can qualify. Just like what happened in 2012. Man, the rental market was crazy in 2012 because nobody could buy houses anymore. Because of the 2008 crash and then all these people who needing to upgrade house or whatever, they couldn't. So they had to rent, and our rents spiked as a result of it. In fact, when have we seen rents go down, Lindsay? When was the last time you saw the rental market actually decline in price?
We have not experienced that in our 10 years. We have not. It has been a steady, and Birmingham is a completely different market than a lot of other areas in the country, but we have seen a very, very steady increase over the last 10 years with our rental rates.
Well, I'd seen some charts that showed there was only one time that even flatlined. And that was between 2012 and 2013, right there at the end of 12, early part of 13, in that 6-month window, they saw it flatline, never saw it decline. And you show that chart side by side with real estate values dropped, but the rents continued on upward decline. So, or upward incline, sorry. So when you think about that, a person who's involved in rental real estate, you're not worried about what the market does as far as the property value. It's kind of like buying a stock that swings all over the place, but does it pay a dividend or does it not? If it's paying a dividend, who gives a damn, right? Well, that's what you're getting in rental real estate. You're getting that monthly dividend. Continue to get that monthly dividend. Continue goes up. It's not a flat dividend. Things continue to rise through time. And we got into this discussion very heavily with Maureen as to why, because of inflation. A lot of people are scared about doing the 30-year fixed loan. There's a risk that it may go away. People have talked about that. I personally don't see it because you don't take away from something from a group like the citizens of the United States very easily, especially something they had so easily for so long. But a 30-year fixed loan is the greatest asset in your investment business, and you need to leverage high, leverage long, pay it off slow. Period. If you do that, it becomes the greatest asset. And a lot of times people are freaking out because, Einstein said compound interest was the 8th wonder of the world. But Einstein was not talking about compound interest in a 30-year fixed instrument with a fixed asset in an inflationary environment. When you factor those two things together, inflation destroys compound interest. You actually pay less than you borrowed. So you got to go back now and watch the conversation with Maureen. It was an hour long, and it's about probably 40 minutes in. And I was showing you a chart that I have access to. It's a tool that was created by Kennesaw State University's accounting department. And I'm the only guy with that tool. So that's coming out, though. I'm going to have you guys test out the app when it's done, and that will come out to everybody. Will have access to that works with us to be able to see the value there is in getting the financing and the leverage.
Yeah, that's very powerful. So yes, if you want any more information about that, please go and watch the video with Aaron and Maureen too, because they really dive in more in depth into that. So that's, I mean, I wanted your magic 8-ball prediction. So I completely agree. I think that there's going to be a lot of changes with the single family homes. Is there anything else you want to add before we part ways?
Well, the only thing I want to add is just keep looking. One, figure out what your baseline needs to be. Always look for the properties to get to that will fit that. And then support those people around you. There's people right now that have their businesses open that were there to serve you before, but may not have the same storefront they had before. If you've got the capital, take care of them. You know, make sure those people are getting what they need to survive, because the only reason that things go crazy is because people go crazy. You know, we would never have some sort of mess like the toilet paper index we have right now with this huge spike in price for the lack of inventory if it wasn't for humans being nuts. So settle down, look at where the realities are, and just focus on what you want to get done. Start your daily routine. And then thank you for letting me on here, Lindsay. I really appreciate that.
Thank you so much. I love it. Yes. Great advice for investors and just anyone in general that might find themselves working from home, and definitely taking care of other small businesses in your community and helping each other out. So that's great advice. Thank you so much, Aaron. I appreciate it.
You're very welcome. If you guys find yourself bored, go to Amazon and look up my books, the QJO Initiative, as in Quit Jerking Off Initiative. There's 4 of them there. Get them. All the money goes towards charity. I'm not taking a dime.
That's awesome. All right. Thank you so much.
Thank you.